Good morning. I call this hearing to order. Welcome. I'd like to start today's hearing by thanking everyone for attending. Specifically, I'd like to thank our distinguished panel of witnesses for taking time out of their busy schedules to participate in what I believe to be a critical issue facing lenders as they work towards providing capital for our nation's small businesses. On Wednesday, June 8th, in response to a question from J.P. Morgan Chase CEO Jamie Dimon at a bankers conference in Atlanta, Federal Reserve Chairman Ben Bernanke stated that there has never been a study that examined the impact of the new financial regulatory structure on economic growth. For many of us in the room today and on this subcommittee, this statement is very troubling. As we work to grow our economy and create jobs, it's critical that in everything we do, we consider how policies made in Washington will impact small business owners that are struggling to make their businesses successful. Regulations always require a careful balancing act, and here we have two very important concerns to worry about. First, we must make sure that the users of financial products are protected. Small business owners and consumers take advantage of a wide variety of financial products to fund their business. For business owners to succeed, they need to have faith that their financing options will continue to be available when they need them and that their money is secure. Customers also need financial products to purchase the goods and services that sustain small business. On the other hand, though, is the burden of regulation and compliance costs associated with oversight. A regulation that chokes off all economic activity is not meeting its purpose. If banks stop lending or cut back dramatically in response to regulators, the regulation itself must be reconsidered. While there is always going to be risk in the financial sector, we need to make sure to manage that risk responsibly so that banks are secure and small businesses have confidence that they can obtain the credit necessary to sustain or grow their business. We cannot afford a system where banks are afraid to take risks on small businesses for fear of regulatory reprisal. Today, we will discuss the new financial regulatory structure that was created by the Dodd-Frank Act. This new law responded to the perceived weakness in the former regulatory regime that left many lines of business without supervision, allowing systemic risk to develop. We know that the Dodd-Frank Act is over 2,300 pages. Within these pages are requirements for 243 new rulemaking actions and 60 studies. According to GAO, it will cost $1 billion just to implement this new law. It will drain $27 billion job-creating funds from the economy over 10 years and require hiring more than 2,600 new full-time government employees. What we do not know, however, is the overall economic impact of this law and what it will do to small business job creation in this country. To help us grasp the impact of the new law, we have a distinguished panel of witnesses who are on the ground dealing with the impact of this new law every day and working to prepare for the new rules coming down the pike. I am extremely interested to hear what these witnesses have to say about how they are dealing with this law and how it's impacting their small business lending. With that, I happily yield to Ranking Member Schrader for his opening statement.
Thank you, Mr. Chairman. Less than 3 years ago, our financial system was thrown into disarray, with Lehman Brothers filing the largest bankruptcy in American history. In the years since, our private and public sectors have taken unprecedented steps to pull us back from the brink and return our economy to a stable path. In the process, we've learned a great deal about what caused the crisis, and it appears that for decades, I think, as we all know, regulators allowed an overabundance of high-risk credit to grow unchecked. And in short, our entire financial system was flawed. and the revised regulatory framework definitely being called for and enacted in the Dodd-Frank bill. While the legislation itself was directed primarily at the financial services industry, we are concerned about its impact and ramifications for all small businesses. It's imperative that as the statute is translated into meaningful regulations, that we carefully consider how these changes might affect our small banks, our small credit unions, and the small business community in general. Community banks and credit unions comprise over 90% of our banking industry, and significant efforts were made in the Dodd-Frank bill to mitigate the adverse effects this new regulation might have on them. Indeed, I hope that in many respects, small banks will benefit from the new law. Lower premiums for FDIC insurance, revised capital requirements, more freedom to open branches across state lines. Community banks should see, hopefully, some reduced operating costs. You'll correct me, of course, if that's not being achieved at this stage. Nonetheless, small financial institutions will have their business models, I think, profoundly changed as a result of these regulations. We're hearing pushback already. We hear the higher compliance costs that are imposed on small firms that don't have the large capacity that bigger firms do to deal with those compliance costs. It's also undeniable that small lenders bear less responsibility, I think, for this financial crisis and should not bear the brunt of all these new regulations, so we want to make sure we get it right. The new regulations created by the Consumer Financial Protection Bureau will be subject to the Regulatory Flexibility Act. This new regulator also becomes just a third agency to be subject to the Small Business Regulatory Enforcement Fairness Act. We're concerned about how it views its mission and how it will impact small businesses and small banks and small credit unions. Businesses on Main Street also rely on the healthy functioning of our financial system. Perhaps no other group has been more affected by the collapse of Wall Street and the big investment banks and its trickle-down effect to the smaller banks than small businesses on Main Street. We still find small firms at previous hearings struggling to find credit. Medium and larger firms are now able to access credit. And we have to be careful that these new regulations do not exacerbate the current capital shortage that we already have out there. Changes to our laws, I think, are overdue. There is this tendency, however, to over-regulate and over-respond to the crisis, and I need to hear feedback from our distinguished panel to make sure we don't go down an overcorrection path. Both lenders and borrowers and small businesses have a lot of stake with this financial reform. The Dodd-Frank Act is going to affect every sector of American economy, and I hope that if done properly as a result of your feedback and the work we'll do to continue to improve the Dodd-Frank Act, that it will create more jobs and more credit will flow. So I also want to thank the witnesses for being here and sharing their wisdom with us, and look forward to the hearing, Mr. Chairman.
Thank you, Mr. Schrader. A couple rules. If committee members have an opening statement prepared, I ask that they be submitted for the record. I'd like to take a moment to explain the timing lights for you. You'll each have 5 minutes to deliver your testimony. The light will start out as green. When you have 1 minute remaining, the light will turn yellow. Finally, it will turn red at the end of your 5 minutes. If you go over your 5 minutes, someone will come in and escort you out of the room. I'm just kidding. I ask that you try to keep it to that time limit, but we'll be as lenient as possible. Before we get to the witness introductions this morning, I'd like to first mention that there's been a great deal of interest in today's hearing from people who could not join us today as witnesses. So I would like to make sure that the hearing record reflects their views. I received a letter from Peter Halius, chairman of Bridgeview Bank Group. Peter's a constituent of mine from Illinois, so I'm pleased that he wrote to share his view on this important issue. So I ask unanimous consent that this letter be made as part of the record for this hearing. Without objection, so ordered. Our first witness today is Thomas Boyle, Vice Chairman of State Bank of Countryside in Countryside, Illinois. I'm very pleased to have someone from my home state of Illinois here today. Prior to Mr. Boyle's current role as Vice Chairman, he was the President, CEO of the bank from 1997 to 2009. State Bank of Countryside opened in 1975 and operates from 6 locations, including its main headquarters in Countryside, plus branches in Burbank, Darien, Orland Park, Chicago, and Homer Glen, Illinois. Mr. Boyle is testifying on behalf of the American Bankers Association, where he has served a variety of leadership roles. Tom has also served as a director of the Illinois Bankers Association. Mr. Boyle, we look forward to your testimony.
Thank you. Chairman Walsh, Ranking Member Schrader, and members of the subcommittee, my name is Thomas Boyle. I'm the Vice Chairman of the State Bank of Countryside in Countryside, Illinois, and I thank you for the opportunity to testify on behalf of the ABA. These are very important issues for thousands of community banks that work hard every day to serve small businesses and our communities. The health of the banks and the economic strength of our communities are closely interwoven. A bank's presence is a symbol of hope and a vote of confidence in the town's future. As a family business, State Bank of Countryside understands the concerns faced by our customers' personal and business lives, and we believe our success is tightly linked to their success. Our motto even reflects this: the family-owned bank for families and their businesses. Banks are working very hard to make credit available in their communities. Efforts are made more difficult by hundreds of new regulations expected from the Dodd-Frank Act. Although these new regulations are inevitable, the sheer quantity will overwhelm many community banks who are already facing difficult times due to the economic conditions in many parts of the country. Second-guessing by bank examiners makes this situation worse yet. Let me give you a few examples of how Dodd-Frank will negatively impact the small business lending. First, new regulations limit access to capital. Capital is the foundation upon which all lending is built. Having sufficient capital is crucial to lending and to absorb losses when loans are not repaid. In fact, $1 worth of capital supports $10 in loans. In the past 2 years, bank regulators have requested greater levels of capital, taking away precious resources that could be used for lending. In conversations with fellow community bankers, I often hear how regulators are pressing banks to increase capital-to-asset ratios by as much as 4 to 6 percentage points above the minimum standard. Dodd-Frank limitations on capital sources have made access to capital even more difficult. The lack of access to capital has caused many banks to become smaller in order to maintain specific capital ratios. The result, loans become more expensive and harder to get. Relieving the increased regulatory demands for more capital will help banks make loans needed for our nation's recovery. Second, Dodd-Frank increases uncertainty for banks, in turn raising credit risk, litigation risks and costs, and leading to less hiring or even a reduction in staff. The uncertainty makes hedging risk more costly and restricts new business outreach. All of this translates into a less willingness to make loans, and worse, increases the likelihood of a massive consolidation. Of particular concern is the additional compliance burden expected from the Bureau of Consumer Financial Protection. This bureaucracy will impose new obligations on community banks that have a long history of serving consumers fairly in a very competitive market. The Bureau should focus its energies on supervision and examination of non-bank financial providers. This lack of supervision of non-banks contributed mightily to the financial crisis. We urge Congress to ensure that this focus on non-banks is a priority of the Bureau. Third, consequences for small business and the entire economy are severe. Costs are rising, access to capital is limited, and revenue sources have been severely cut. It is difficult to meet the needs of local businesses when we're dealing with regulatory overreaction, piles of new laws, and uncertainty about the government's role in the day-to-day business of banking. This will undoubtedly lead to a contraction of the banking industry. We must work together to ensure that banks meet the needs of small businesses and their communities. Thank you for the opportunity to present the views of the ABA, and I'm happy to answer any questions.
Thank you, Mr. Boyle. I'd now like to introduce our next witness, Mark Sekula, Executive Vice President and Chief Lending Officer at Randolph Brooks Federal Credit Union. Mr. Sekula has 25 years of lending experience covering credit cards, mortgage, commercial, indirect lending, and collections. Mark and his team currently manage a $200 million commercial portfolio that includes SBA lending. In 2009, Randolph Brooks was recognized as the SBA Credit Union Lender of the Year. Mr. Sekula is testifying on behalf of the National Association of Federal Credit Unions. Welcome. You have 5 minutes to present your testimony.
Good morning, Chairman Walsh, Ranking Member Schrader, and members of the subcommittee. My name is Mark Sekula, and I am testifying today on behalf of NAFCU. I serve as the Executive Vice President and Chief Lending Officer for Randolph-Brooks Federal Credit Union, headquartered in Live Oak, Texas. NAFCU and the entire credit union community appreciate the opportunity to participate in this discussion regarding the Dodd-Frank Act's impact on small business lending. Despite the fact that credit unions are already heavily regulated and were not the cause of the financial crisis, they are still within the regulatory reach of a number of provisions in the Dodd-Frank Act, including all credit unions being subject to the regulations and rulemaking of the Consumer Financial Protection Bureau, CFPB. This means credit unions like mine are facing a host of new compliance burdens and costs. As it relates to our business lending, the creation of the CFPB, the breadth of its power, and the costly regulations it will undoubtedly prescribe will impact how we allocate our resources for our membership. For example, Section 1071, which has not received much attention, creates a data collection system for small business lending similar to the Home Mortgage Disclosure Act for financial institutions. Under Section 1071, every financial institution will need to inquire whether the applicant is a small business or women or minority owned. While well-intentioned in its own right, it is yet another compliance burden emerging from the Dodd-Frank. Furthermore, given that credit unions serve a defined field of membership, individual credit unions' information, in comparison to other lenders, could be skewed. Credit unions are chartered to serve their members. Thus, regulatory data collection that is intended for institutions that can serve anyone should not be imposed on credit unions. The financial institution must also maintain a record and report it to the CFPB. The information must be made public in accordance with the CFPB regulations. These provisions are effective on July 21st, yet implementing regulations will not be issued until after that date, leaving financial institutions with no compliance guidance on the effective date. While the CFPB has indicated that compliance will not be mandatory on July 21st, Congress should consider delaying the effective date of this provision until such time as implementing regulations take effect. The Dodd-Frank Act also includes a section 1100G, that says the CFPB must evaluate the impact that its actions have on small entities. We believe that credit unions meet the definition of a small entity. We would urge Congress to ensure that the CFPB abides by this congressionally mandated standard and does not try to narrow the definition of small entity in the future. The environment around regulatory reform has led regulators to make changes that impact credit unions and may cause them to tighten their lending to small business. At Randolph-Brooks, our SBA loan volume has diminished in recent years, partly due to the economic downturn, but also because of the inconsistent nature of SBA examinations. On one hand, the SBA encourages granting small loans to qualifying businesses. Yet, on the other, the agency states that a lender status with SBA can be rescinded if these higher-risk loans default. The SBA provides a lender portal and a lender score from the SBA's credit risk assessment model. Our score is derived by averaging other lenders, mostly large 7A loans, with our small SBA Express loans. The blending of all lenders with varying portfolios to arrive at a score dilutes the true picture, as one cannot compare a small SBA unsecured working capital line of credit with a large SBA loan secured with commercial real estate. The two loans should not have the same evaluation process. If this does not change, it may eventually drive all small loans from the lender's portfolios. In addition to the SBA scoring problem, practices by other regulators have had an impact as well. Last year, the National Credit Union Administration, the NCUA, issued a rule to amend the agency's regulatory flexibility program known as RegFlex as it relates to business lending. The new rule requires a personal guarantee for all credit union member business loans, as MBLs. Unfortunately, this proposal will make credit union MBLs significantly less attractive to members. NAFCU believes and has told the NCUA that requiring a personal guarantee for all MBLs is unnecessary given the underwriting policies that RegFlex credit unions already have in place. Currently, there is a divide between Congress, the administration, and other policymakers that wish to spur lending and the regulators that oversee financial institutions. On the one hand, we sit in this hearing today discussing ways to encourage small business lending. On the other hand, regulators explicitly create barriers to new lending by regulation, the exam process, and implicitly warn credit unions against making any loans that may be deemed risky. Forced to choose between these two conflicting objectives, Randolph-Brooks must, of course, follow the directive of our regulators. In short, any congressional goal to promote lending will never be successful when the regulators are not on the same page. I thank you for the opportunity to appear before you today on behalf of NAFCU and would welcome any questions that you may have.
Thank you. I'd again like to recognize Ranking Member Schrader, who's going to introduce our next witness.
Very good. Thank you, Mr. Chairman. Bill Daley is the Legislative and Policy Director for Main Street Alliance, a national network of state small business coalitions that give, hopefully, small business owners a voice in all this discussion, particularly those small businesses that are busy trying to put food on the table and create jobs and unable to come to Washington, D.C. to testify. Prior to joining the Alliance, Mr. Daley worked on the staff of the Washington State Legislature, numerous state agencies, and served 2 years as Mayor of Olympia. So you've been in the trenches, sir. Thanks for coming, Mr. Daley. We look forward to your testimony.
Chairman Walsh, Congressman Schrader, members of the committee, thank you very much for the opportunity to testify on behalf of our small business owners. We represent organizations in 14 states. Our members supported the passage of Dodd-Frank, and particularly some provisions of it very important to us. Our interest is essentially economic. When the Great Recession hit, small businesses were among its major victims. As of late 2009, small business job losses were responsible for about 2/3 of the employment decline that occurred as the recession came, and small business bankruptcies nearly doubled March to March 2008-2009. We're still suffering from a significant loss of our customer base, held down by high unemployment rates and the foreclosure crisis. We don't want to go through this again. It is important that this law be implemented, and we don't want to see it undermined as the effort to make it work goes forward. Let me comment on a couple of specific issues about Dodd-Frank. Whether or not the act causes a credit crisis. Our small business owners hear a statement like that and they kind of bristle. We do have a credit crunch in small businesses. Credit dried up well before Dodd-Frank. Credit dried up because Dodd-Frank wasn't in place. We had a meltdown that could have been mitigated or prevented. Blaming the act for a crisis-induced credit crunch confuses cause and effect. We lost our customer base, and until those customers begin to return, there will be a credit crisis for small businesses. Second, Dodd-Frank is a source of uncertainty in the economy. Surely the implementation of any act of Congress causes some uncertainty, and something this big and complex will cause uncertainty. But we think that a period of uncertainty is important to go through in order to have certainty in the future about the credit that we can obtain. And Dodd-Frank provides protections for that. So we're tolerant of a little uncertainty in the short term to get certainty in the long term. Will the Act's reserving limits, new reserving requirements, limit small business capital? I think it remains to be seen whether that will be the case, although you've heard some concern about that from the testimony so far. The improvements in the requirements to protect against risk that are associated, however, with these new reserving limits are important. Let me parenthetically comment about the availability of capital. The financial institutions reserves now are at levels that even the Wall Street Journal calls eye-popping. There's last year $1.2 trillion in excess reserves beyond amounts required by law. That increased in the first quarter of this year by $2.225 billion. And the money is sitting in the Fed gaining interest at a 0.25% interest rate. Putting that investment back into the economy would help us tremendously. And then our new data requirements a hindrance or a benefit to small businesses. Again, I think I have to be real clear about it. Our folks don't like paperwork. Thank you for getting rid of the 1099 provision. There's a considerable flexibility in the Act about how the rules are imposed with regard to this requirement, We think it remains to be seen just how much of the burden will fall on the small business, how much will fall on the lending institution. And then I want to close by noting some features of the Dodd-Frank that our members find especially attractive. Swipe fee reforms are a benefit to our small businesses. They will help save us some money. We like the Consumer Protection Bureau. We are all financial customers ourselves, and our members have been harmed by attractive but risky products. Dodd-Frank helps restore focus on traditional lending through limits on proprietary trading. In short, Dodd-Frank is a good thing for small businesses, and we hope that its progress will not be hindered.
Thank you, Mr. Daley. The final witness that I have the pleasure of introducing is also from Illinois, Mr. Greg Ohlendorf. Greg is President and CEO of First Community Bank and Trust in Beecher, Illinois. First Community Bank and Trust specializes in small business lending, including commercial real estate. Mr. Ohlendorf is testifying on behalf of the Independent Community Bankers of America, where he serves as chairman of their Policy Development Committee. Mr. Ohlendorf, you have 5 minutes to present your testimony.
Chairman Walsh, Ranking Member Schrader, and members of the subcommittee, I'm Greg Ohlendorf, President and CEO of First Community Bank and Trust, a $147 million asset community bank in Beecher, Illinois. I am pleased to be here today to represent the nearly 5,000 members of the Independent Community Bankers of America. Thank you for convening this hearing on the Dodd-Frank Act and its impact on small business lending. Community banks are prodigious small business lenders. In his recent speech before the ICBA annual convention, Federal Reserve Chairman Ben Bernanke shared new research that shows while overall small business lending contracted during the recent recession, lending by a majority of small community banks, those of less than $250 million in assets, actually increased. By contrast, small business lending by the largest banks dropped off sharply. The viability of community banks is linked to the success of our small business customers, and we don't walk away from them when the economy tightens. Community banks have little in common with Wall Street firms, mega banks, or shadow banks. We have a much different risk profile because our business model is built on long-term customer relationships. We cannot succeed without a reputation for fair treatment. We make quality small business loans often passed over by the large banks with their statistical models because of our personal knowledge of the borrower gives us firsthand insight into the true credit quality of a loan. These localized credit decisions made one by thousands of community bankers will restore our economic strength. The Dodd-Frank Act is a generational law and will permanently alter the landscape for financial services. It has proven to be a mixed outcome for community banks, combining both punitive and helpful provisions. Every provider of financial services, including every single community bank, will feel the effects of this new law to some extent. While there are many provisions of the law I could discuss at length, I'll focus my comments on the new CFPB. Community banks are already required to spend significant resources complying with consumer protection rules. This compliance burden is a distraction from our small business lending. Every hour I spend on compliance is an hour that could be spent with a small business customer. CFPB rules should not contribute to this distraction. The CFPB should use its authority to grant broad relief to community banks where appropriate. ICBA also supports legislation recently passed by the Financial Services Committee to reform the CFPB to make it more balanced and accountable in its governance and rule writing. Probably the most frustrating aspect of the current regulatory environment is the trend toward oppressive exams. The misplaced zeal and arbitrary demands of examiners are having a chilling effect on small business lending. Good loan opportunities are passed over for fear of examiner write-downs. I am fortunate in my bank to enjoy a cooperative and constructive working relationship with my regulator, the Federal Reserve Bank of Chicago. Examiners perform a difficult job, and the stakes were raised sharply after the financial crisis, but I believe many examiners have overreacted to the crisis. I've met with hundreds of community bankers from every part of the country in recent years, and I can tell you there's an unmistakable trend toward arbitrary, micromanaged, unreasonably harsh examinations that have the effect of suffocating small business lending. ICBA supports legislation to bring more consistency to the examination process. Arbitrary loan classifications are a particular source of frustration for community bankers. Representative Bill Posey's Common Sense Economic Recovery Act, H.R. 1723, would establish conservative, common-sense criteria for determining when a loan is performing and provide more consistent classification guidance. This bill would give bankers flexibility to work with struggling but viable small business borrowers and help them maintain the capital they need to support their communities. The ICBA-backed Communities First Act, or CFA, H.R. 1697, introduced by Representative Blaine Luetkemeyer, contains many reforms that would improve the regulatory environment and community bank viability to the benefit of our customers and our communities. To cite just a few examples, CFA would raise the threshold number of bank shareholders that triggers SEC regulation from 500 to 2,000. SEC compliance costs are a significant expense for listed banks. Another provision would extend the 5-year net operating loss carryback provision to free up community bank capital now when it is needed most. We're very pleased that CFA has bipartisan co-sponsorship and look forward to its advancement in the House. Given the state of the private capital markets for small and mid-sized banks, which are largely still frozen since the financial crisis, ICBA supports the Small Business Lending Fund as an alternative source of capital for interested, healthy banks structured to incentivize increased lending. We hope that the first round of capital will be dispersed soon. Thank you again for your commitment to small businesses and your interest in the institutions that partner with them. I've outlined some of the more significant regulatory challenges we face in the months ahead. Thank you for hearing our concerns. We look forward to working with you.
Thank you, and thank you all for your testimony. Let me begin my series of just a couple brief questions. And this first one will be directed toward each member of the panel. Try to be brief and specific with your answer. Dodd-Frank, an appropriate reaction to the financial crisis, an overreaction, or a reaction that wasn't strong enough to the financial crisis? How would you answer that? Brief and specific. An appropriate reaction, an overreaction, or not a strong enough reaction? Let's start here and we'll work our way down.
Dodd-Frank's a mixed bag. There are many provisions that are, I think, an overreach, and there are some provisions that I think are very helpful, including deposit assessment reform and the assessment base that community banks and other banks are able to take advantage of, which are going to save us a whole lot of money and put the burden more appropriately where it needs to be. There are other provisions of Dodd-Frank that, frankly, scare us tremendously. The CFPB, while we have a bit of an exemption or a carve-out in community banks, we're still subject to their rule writing. Today, what we have to understand is we're already overburdened with regulation. We have a significant number of regs that we need to comply with today, and it seems like just one more isn't going to change the deck a whole lot. But the piling on and the consistent piling on of additional regulation is very, very stunning. In the good old days, I had a part-time person that did 10% of their job in the area of compliance, and we complied with all the rules of the land. Today, we've got 6 or 8 people, all senior officers that sit on a compliance committee attempting to deal with these reforms as they come along, and that's punishing, and it's very difficult for small institutions.
Mr. Daly, an appropriate reaction, an overreaction? There you go.
Thank you. I think our members would say it's largely appropriate. The process in the Congress was fascinating to watch for us. And the balance that came through the debate and exchange it really served the country well, we think. There are a couple of areas where we'd like to see things stronger. The proprietary trading provisions we thought could be strengthened. We would have liked to see the swipe fee rules applied to credit cards as well as debit cards. But overall, the work of the Congress seemed appropriate. I also think it's appropriate for to continue your work now. Congressional oversight of the implementation of this act is important. It's good that you're holding the hearing here, and there are other hearings, because that balance that we think was achieved in the Congress needs to be achieved in the implementation of the act. Mr.
Sekula.
NAFCU does not blame, Dodd-Frank for the credit crunch, but we do believe that it overreaches and is an overreaction, as all credit unions are under the CFPB's rulemaking authority. A couple items that we do like, we feel positive about the Dodd-Frank, of course, is, as mentioned earlier, the permanent increase in the federal deposit insurance from $100,000 to $250,000, and plus consumers do need protection from predatory lenders, and we understand and we support that view, and we're just hopeful that that more time will be spent on unregulated entities such as payday lenders, be the focus from the CFPB.
Mr. Boyle.
I feel that it's an overreaction. In our shop of $800 million bank, we have 2 full-time compliance officers, and we also outsource a third party to make sure we remain in compliance. We're anticipating, with the uncertainty that the Dodd-Frank bill is going to bring, that we are actually interviewing additional consulting firms that could cost us anywhere from $75,000 to $125,000 going forward to make sure we maintain our good standing in the compliance arena. So we feel that it's an overreaction.
Thanks. Mr. Daley, quick question, and I'm confused, and I apologize for that. Just briefly describe your members to me, because I think if I took you by the hand and you and I walked around my district for a day and we talked to 50 small businessmen and women, you'd hear the same refrain. They're scared to death. There's so much uncertainty out there, and there's a lot of angst about the additional regulations and the regulatory climate that they believe Dodd-Frank is going to lead to. Your members are fine with what's coming?
May I describe our members? They are small businesses. We have about 10,000 members. Our members are the owners, and they own and operate their businesses. They are more. I talk to them a lot. We're in fairly constant communication. And they come here a lot to testify to Congress and go to meetings. They're more concerned about the long-term return to practices that put them in the tank. And when I have these conversations with our members, that's their greatest concern. They see the problems that were caused by these practices as having harmed them, as having destroyed their customer base, and that the law that's being put in place to prevent that from happening in the future is important.
Did they feel overregulated before Dodd-Frank?
When I talk to them about the operation of their businesses, they don't talk to me about regulation. They talk to me about what is going on in my community. My community is the quality of life and the quality of the local economy is what's important to them. They don't draw their business from around the state or around the country or internationally. They draw their business from their community. And their community's in trouble now, and their business is in trouble as a consequence. So they don't talk to me about regulation. They don't talk about taxes. They talk about getting investment into the community, getting jobs into the community, so that my business can continue to thrive.
Boy, you and I are talking to different folks. That's fascinating. It actually is. One final quick question, Mr. Ohlendorf. Are you getting consistent information from regulators about your portfolio?
I talk to a lot of bankers around the country, and we feel like there's some very inconsistent data. I talked to a banker on the way to the airport yesterday from one of our neighboring states who was dealing with an appraisal. And they had gotten the appraisal, it's supposed to be the be-all, end-all, that this is the value of the property. And they were concerned about some of the assumptions. So they shared some of their thoughts on those assumptions with the appraiser or with the examiner. And the examiner came back and said that that bank had no business making any changes to the assumptions of the appraisal. Okay, fine. A banker 30 minutes from that bank had a set of examiners in and had a piece of commercial real estate that was worth, on their books, $4 million. It had just been appraised at $4 million. And the regulators came in and asked that bank to charge that loan down to $2 million because the appraisal wasn't worth anything. As a banker, and in trying to work in this economy, how am I supposed to take those two stories that are both very current, banks that are 30 minutes apart in a neighboring state, and gel that together to understand what I'm supposed to do to help make small business loans? I can't have arbitrary 50% write-downs to my portfolio when the appraisal just indicated that the value was what I said it was. And on the other hand, I can't look at another appraisal and try to, say, well, maybe some of those assumptions aren't accurate and try to massage it because they were told they didn't have the credentials and the expertise.
Thank you. I now turn to Ranking Member Schrader.
Thank you, Mr. Chairman. As I listened to the panel, it would appear that the biggest problem seems to be the regulators, maybe more than Dodd-Frank itself. And I hear that same song and verse back at home with my local banks, credit unions, that you get that inconsistent regulation. Question for Mr. Ohlendorf, Mr. Boyle in particular. On in Dodd-Frank, they talked about a 5% capital requirement holdback that was going to be mandated. And maybe even some flexibility for mortgage-based loans. But when I talk to some of my folks at home, they're saying, well, actually, we're getting rules that are talking about a 20% down payment and stuff. Could you comment on, are you hearing that also? That would seem to be in contravention to what was put out there. Mr. Ohlendorf and then Mr. Boyle.
We've heard that discussion. We're concerned that the horse is out of the barn. Back in the days when I started in banking, a 20% down payment may have been traditional, and you saved up money and you tried to buy your first house. The rules somewhere along the line were changed significantly, and obviously lower down payments were allowed, and which fueled tremendous boom in the housing industry, and a lot of first-time home buyers were able to buy homes that weren't. And we can argue the political policy of that for all it's worth for a long time, and that's not probably what you want to do. But the problem that we have today is to go backward to that is going to have significant additional downward pressure on real estate. There's a lot of real estate out there, and if only people with 20% down payments are eligible to be able to buy a home, it's going to be very difficult to take and handle the slack and the supply.
Are your regulators mandating that right now?
We're not seeing it mandated right now, but we've seen it talked about in a variety of number of places within some of the proposed regulations. You know, a limit at some level of a required down payment may be appropriate. 20%, I believe, and the ICBA believes is too high.
Okay. Mr. Boyle?
We also believe that the 20% is excessive, but we do believe that the borrower should have some skin in the game, and maybe the right answer might be 10%. But in our marketplace, and Greg's as well, you know, we're in a relatively upscale type of product, and if it's very difficult for someone to save $80,000 to $100,000 as a down payment. So there needs to be some adjustment from the 20% down to a more manageable number to allow younger people to move into communities.
Okay, yeah, I would hope that'd be the case. I mean, I had to do that way back when, but times have changed, and I believe we got way too lax, and even prior to Dodd-Frank, we were making lots of mistakes. So some intermediate area, and hopefully our committee and others will talk to FDIC and some of our friends, comptroller, to make sure that they get this right. I guess, Mr. Daly, it would appear to me that from your testimony, you feel that access to credit has been a long-term issue for small businessmen, and irrespective, I guess Dodd-Frank came last year, and prior to Dodd-Frank, if I look at the graphs, it looked like small business credit was inaccessible long before Dodd-Frank came into being. Would that be your assessment also?
The difficulty our members expressed to me about access to credit has to do with the idea that they're reluctant to borrow and lenders are reluctant to lend if their business isn't thriving. The key question for them is customers. We need people coming in the door with money in their pocket. And when that happens, it's easier for us to borrow. Let me mention one borrowing phenomena for small businesses that is important, and that is a lot of small businesses, startups, are financed by equity in their homes. You'll see a great deal of that. The people will start up a small business by borrowing against the equity in their homes, and the housing crisis, the drop in housing value throughout the country has had an impact on that as well. And I think as you evaluate the credit problem for really small businesses, you need to think of that as well.
So it's a long-standing, ongoing issue, irrespective, I think, of the new regulations.
It came well before the passage of this bill or the introduction of it.
I guess I had a question regarding small business lending. Small businesses come in all sizes, apparently. They're not just small. There's, under 500 employees, under certain, gross retail volume, you fit into a small business category. Get a comment from you, Mr. Sekula, and Mr. Boyle, on which small businesses are now getting credit, because anecdotally I hear back home that for some of my larger small businesses, it's okay. For some of my smaller small businesses, not so much. What are you seeing? Do you see that differentiation, or is lending improving slowly but surely for all those businesses?
Well, for lending for Randolph Brooks, our members, our small business members, are still able to get loans. We've recognized continued growth through our portfolio for the last 3 years in a row. Where we're running into a problem is that we've been, as an SBA lender, we've had problems being able to maintain. See, our membership is specific. I mean, they're at military, Air Force. We support the Patriot Express SBA program. And as a result, we're the number 5 largest Patriot Express lender in the country for a credit union. So that's our membership. That's who we're serving. They're coming to us for these Business Express lines of credit under $50,000, and we're granting them. I think probably close to 75% of our portfolio is made up of those type of loans. Those are, our average loan size on the SBA side is only $44,000. So those are the members that are coming to us that we're trying to serve. The problem that we have is that we just completed an SBA exam, and it was cited as a finding that we needed to improve our delinquency rate, our past due rate. If not, we run the risk of losing our preferred lender status and access to these funds. Well, as we look at the lender portal that the SBA puts out, our numbers as we view it are great. We think that they're good. So we don't know if SBA added this as a finding, as the shot across the bow, as a warning maybe for all financial institutions. But as a result of by listing it into a finding, I have to address and explain what our actions are going to be to make sure that delinquency and those losses don't go up, yet we're a well-capitalized organization. Our underwriting standards are top-notch. Our performance is great. And here we are, we think that we're doing things right. Our numbers show that we're doing things right, but yet the SBA is now telling us that I've got to put a plan in action to improve those numbers, which means then now instead of me focusing on these loans that are for the $35,000 to $50,000 range that our membership is asking for, now I need to focus on maybe a larger 7A loan or a 504 loan just so I can make my numbers look better. Right. That's not my membership. That's not what they're asking for. And so as a result, that's the biggest problem I have. Now, in defense of the SBA, we've had a great relationship working with them since we've been offering SBA loans. And also in their defense, we just got our write-up, our finding, 2 weeks ago. So as a result, I have not had an opportunity to respond back to them about my concerns. But since the timing of this hearing was right now, I felt it was important to share it because I feel that I'm not the only institution, or we're not the only institution experiencing these type of experiences with the SBA.
Very good. Mr. Boyle?
We believe that each individual credit request is unique in and of itself, and we are a relationship lender by nature. And we always have viewed our business is to make loans. We're not profitable unless we make loans. I will admit to the fact that over the last 2 years, the underwriting has significantly increased, and that the scrutiny and the requirements from the businesses, the additional information that we request is probably more than we have in the past. But it is our goal to continue to make small business loans going forward, because without it, we're not profitable.
I'll yield back, Mr. Chairman, to let the others.
Thank you, Mr. Schrader. I now turn to my colleague from Colorado, Mr. Kaufman.
Thank you, Mr. Chairman. You know, I want to say, first of all, one of the stunning things that is lacking in Dodd-Frank, and I think it's part due to the fact, well, largely due to the fact that government never wants to point the fingers at itself. But if we look at the catalyst of the financial crisis, it's subprime lending, and who mandated subprime lending, who was the one who came forward with this policy that said, let's take people that really can't afford these homes and let's put them in these homes, you know, and then, of course, we'll securitize it and bundle it up, and credit rating agencies missed it, and so therein lies the catalyst of this crisis, and it was government. And guess what's not included in Dodd-Frank? Fannie Mae, Freddie Mac. The very catalyst that drove us into the ditch is nowhere mentioned, because the very politicians who wrote it had their fingerprints on it. And so I just think it's stunning that we've not dealt with that issue that is the basis of really the problem that we have today. But let me just ask this question to the three bankers, and that is, are regulators communicating with each other, or are you answering duplicative questions from various regulators? Mr. Boyle?
In our situation, we're of a size where most of our, or all of our examinations are a joint examination between the FDIC and the state, and we have not seen a duplication of questions. They've seen in Chicago, the FDIC is very well organized, and getting the requirements ahead of time makes the examination as least burdensome as possible, even though it takes 4 weeks.
In regards to the National Credit Union Association, communication with them has been very good in regards to some of the expectations coming down for that, giving us an opportunity to prepare. Whether they coordinate with the SBA on any of their exams or audits, that is information I'm not aware of. So, sorry, I'm not able to add much more information to that.
We're federally regulated by the Federal Reserve and the state, and we've experienced very little difficulty in communication. Where there have been overlaps, we've brought it to their attention where they've asked us to do things twice, and in general sense that they've been able to work that out amongst themselves. So I don't think it's the nature of them doing duplicative things. I think that we have other issues that need to be addressed.
Great. Thank you, Mr. Chairman. I yield back.
Thank you. I'll now turn to my colleague from Michigan, Mr. Peters.
Thank you, Mr. Chairman. Much of the testimony that we've been hearing today has been kind of focused on some of the potential negative aspects of Dodd-Frank, and I say potential because most of the bill has not gone into effect, and so the criticism that we're hearing is speculative in nature at this point. And yet we've already seen numerous attempts from the Republican majority to delay, to weaken, and even to kill this new bill. Community banks and credit unions certainly did not cause the financial crisis. In fact, in many respects, I believe that you were among the worst victims of the crisis. There have been hundreds of bank failures since the 2008 financial crisis. And each time one of these banks fails, another community lender isn't in a position to make critical small business loans. As was mentioned, where most of the small businesses come from are credit unions and small community banks. But now that the worst of the crisis is over, there seems to be a tendency to forget what caused it and how it affected Americans all across the country who lost their jobs, their homes, and saw their retirement savings vanish. I want to work certainly with the industry to make sure that this bill is implemented in ways that work, but I also believe it's very short-sighted to lose focus of the fact that the bill was passed in the face of the worst financial crisis in generations that absolutely destroyed our economy. A crisis that was caused for a variety of reasons that caused it, but it was excessive speculation and risk-taking, particularly by some of the very large, systemically risky institutions that are in our country. And so I think that needs to be the focus of what we're looking at reforms. Folks here before us on the panel are not part of those large systemically risky institutions, but we need to address that so we don't ever have a situation where we're put into a catastrophe like we had. So with that kind of premise, Mr. Boyle, I want to direct this question to you, is that when small banks get into trouble now, the FDIC will come in and will unwind them through a orderly dissolution process. As you know, that didn't exist for some of these very large institutions that caused a significant problem for our economy as we were going into off the cliff. The Dodd-Frank bill did create a new dissolution process for these large systemically risky institutions. What's your assessment of that? Is that helpful to small banks, and does it help put smaller banks on the same footing that these large institutions will be under?
The Dodd-Frank Act and its treatment of the too-big-to-fail concept was probably one of the better aspects of the bill. With regards to leveling the playing field, the Chases and the Bank of Americas are not my competitors. My competitors are my local community banks within the metropolitan area of Chicago. So I do not think that it leveled the playing field. We each carve out our own niche, and we don't view the Bank of America as our competitor.
But now you talked about the too big to fail is probably the best part of the bill. Would you just elaborate on that, please?
Well, I think the way that they would deal with the orderly liquidation or the solving of a problem of a too big to fail. Having a system in place that doesn't exist currently.
Do others share that opinion?
I think one of the obvious benefits was the whole change in the FDIC Act and the assessment base and so on, but also one of the other major provisions that we have yet to see how it's going to work out is bringing the shadow banks and the mortgage brokers and the non-regulated financial institutions into the fold. Our consumers don't understand the difference when they hear someone can make them a mortgage loan. They don't understand, Congressman, that that person may be or may not be from a regulated financial institution. They assume that they may be getting a better rate, or it looks like a better rate, but they're not sure that we're playing by all the same rules. Their assumption is we are all playing by the same rules, and in fact we're not. And if in part of this crisis we can rein that in, find out who those folks are, and bring them under the same type of regulation that we've long been under and have successfully operated under, those types of rules, I think it's going to make a major change. That's yet to be seen.
Well, again, a lot of this still has to be implemented going forward. So we're in the very beginning stages, which is why it seems to be premature to try to unwind this, because I agree with you that we had a system prior to Dodd-Frank that had heavily regulated institutions like yourself and everybody at this panel here. We had silos of regulation, but between those silos there was a lot of open area where people would compete, and they were your competitors, whether they're payday lenders or other folks that are in that shadowy area that is significant competition to you. And they're playing in an unregulated environment, and they are using tactics that often are predatory on customers. You know, you're trying to do what's right for your customers. You're playing by all the rules. You believe in having a long-term relation with those customers, and yet you have folks out there who have a whole different business model, and it's disruptive to your ability to raise funds, raise capital, invest in small businesses if you've got to compete with these shadowy organizations. So Dodd-Frank is a move forward to try to rein in that practice and those unsavory type of business practices. And so I look forward to working with you so that we can continue to do what's right for the American consumers and the American taxpayers, and stand up to some of these very large systemically risky financial institutions as well that cause so much trouble in our economy. So with that, I'll yield back my time.
Thank you. Now it's my pleasure to hear from my colleague from South Carolina, Mr. Mulvaney.
Thank you, Mr. Chairman. Gentlemen, I've run a couple of small businesses. I've started 3 or 4 of them myself. I've served on this committee now for about 6 months with the rest of these gentlemen. And I have to admit that I've never heard anybody come in and talk about the things Mr. Daley has. Mr. Daley, you've heard the Chairman say that he might be speaking to people who are different than the people you are talking to. Is that at all possible?
I don't know. How would I assess that? I do talk. I actually have a business myself. It's very small, and have in the past operated small businesses. I've worked in, as was mentioned, as a mayor in a small town, small-time mayor actually, in a small town, Olympia, Washington, where I lived for many years, and worked with the business community closely as we tried to bring back our downtown, revitalize the core of the city. I find the values that I experience when I interact with small businesses to be close to what I've described here. They're very concerned about the quality of their communities. They choose to do business with banks like the ones that are represented, or financial institutions like the ones that are represented here, because they have a relationship to the communities. And they do that when they can and appreciate them.
And let's talk about those businesses for a second, if we can, because I admit when I came in to prep for this meeting, I know who the American Bankers Association is, I know who the federal credit unions are, and I know who the Community Bankers of America are. In fact, all of those organizations are very active in my state of South Carolina. I had not been familiar with the Main Street Alliance, but was surprised to find out that it is also active in my home state of South Carolina through an organization called the South Carolina Small Business Chamber of Commerce. And as I was sitting here, I just learned that, Mr. Daley, as I was going through the Internet while you were testifying. I'm familiar with this organization, and I think it would be of value to those of you who heard testimony today and to this subcommittee to recognize who that group is in South Carolina, if it's representative, Mr. Daley, of who your organizations are. It is a organization that exists only on paper. Its core group is a liberal talk show host, a Democrat lobbyist, a Democrat political consultant, and a Democrat public relations specialist. They supported Obamacare, including the public option. They supported cap and trade, and they actually got very active in South Carolina in encouraging the state government to create a new agency to oversee small business. In fact, the quote that they had that was much talked about in my state was, "Let's acknowledge that small businesses are a pillar of success in the state and are just as deserving of a new state agency to lead them." I've never heard of a small business group talk about creating new state agencies to oversee them. Actually, in South Carolina, they claim to have 5,000 members, just as you heard Mr. Daley claim that nationwide they have about 10,000 members. The only way they get to 5,000 members in the state of South Carolina is by using the lists of the South Carolina Association of Trial Lawyers and the South Carolina Association of Claimants Attorneys. I heard Mr. Daley testify earlier today that he actually likes the uncertainty that comes with Dodd-Frank, which would surprise me none, as trial lawyers love uncertainty. Mr. Daley, before I was a small business person, I was actually a trial lawyer, so I've been down that road as well. The NFIB has spoken out against South Carolina Small Business Chamber of Commerce, another organization that I'm a little bit familiar with, as have our two largest chambers of commerce in the state of South Carolina, decrying it as nothing more than a front for the trial lawyers in our state. It does not surprise me then, sir, that you've come in here today to defend Dodd-Frank, and in all fairness, probably just reaffirms my position that the bill is a complete travesty to begin with and should be repealed in its entirety. Thank you, Mr. Chairman. I yield back the balance of my time.
Mr. Chairman, may I, for the record, point out that we do not have an affiliate in South Carolina, and we are not affiliated with the Small Business Chamber of Commerce.
To that point, if I may reclaim my time, Mr. Yes. Chairman, your website identifies 14 agencies, 14 state agencies that make up your base, essentially your affiliate agencies. They include the Idaho Main Street Alliance, the Colorado Main Street Alliance, the Iowa Main Street Alliance, the Maine Main Street Alliance, something called the Keystone, which I assume is Pennsylvania, and then very clearly on your website, the South Carolina Small Business Chamber of Commerce. Thank you, Mr. Chairman. I yield back.
Thank you. I now turn to Ms. Clark, my colleague from New York.
Thank you very much, Mr. Chairman, and thank you, Ranking Member Schrader. I have a statement that I'd like to insert for the record, Mr. Chairman. Thank you very much. Let me just start by recognizing the support in my district in Brooklyn, New York, for the work of community banks and the credit unions, and acknowledge that, as all of America knows, your entities were not a part of what took down our economic system. And so we want to thank you for your steadfast work and your commitment to the growth and development of communities across this nation and the businesses therein. Let me ask my question to Mr. Daley, and let me say that we recognize how much small businesses have suffered during the downturn, and that you welcome many of the provisions of Dodd-Frank. One of the #1 issues that I hear when talking to small business owners and entrepreneurs in my district is the lack of access to capital. I think, it's almost a mantra at this point. So my question is, given that small businesses we all recognize as the engines of our economy, and recognize that Dodd-Frank is the law of the land, what else can be done to get lenders to free up the over $1 trillion in reserves that they're holding, and so that small businesses can hire again and power our economy toward a full recovery? Or is the business model of lenders so inflexible at this stage that it simply cannot adjust to the current regulatory environment?
During the meltdown, the Congress passed a law allowing the Fed to pay interest on surpluses. They're currently paying interest on surpluses that are way in excess of the required financial holdings. And we raised the question as to why. Why is that money not being invested back into the economy rather than sitting in the Fed gaining interest? And I hope you will take a look at that question. There are some other things that might help our customers that are related to lending that are not related to the lack of capital, and one of them is the foreclosure crisis. It's a tremendous drag on the neighborhood economies, and efforts by the government to try to get these underwater loans drawn down haven't proven very successful and haven't been very aggressive. And we have a continuing drop in the value of housing, a continued lack of construction, in industry. It would help us tremendously if that crisis could be closed. So two answers. Take a look at why we're sitting on all this money, for one, and please take a look at that foreclosure crisis.
Thank you. Do any of you gentlemen want to add your perspective to that question? Trying to figure out, what is it? Is it that it's hard to adjust to the current regulatory environment, or what would you say? Yes. Mm-hmm.
One way for us to increase our lending would be for a reduction in the stringent capital requirements put on us by the FDIC. We're currently holding 9% capital. If we could get that reduced to just 8.5%, we could make as much as $10 million in new loans. So the joke around our institution is the accountants are running the bank because everything we do is dedicated towards the achievement of the 9% capital ratio.
One of the other things that I'd like to mention is in the days gone by, we were able to show sources of liquidity to the regulators as lines of credit with our correspondent banks, lines of credit with the Federal Home Loan Bank, the discount window authorization, relationships with maybe brokered CD providers. Today, the regulators are asking us for on-balance sheet liquidity. They don't trust that we're going to be able to draw on those lines because some of those organizations have withdrawn lines from banks that show some signs of weakness. So instead, now I need to hold on my balance sheet levels of liquidity that were prior unheard of in dollars and cents. So part of it, again, is going back to what I'm being required to hold on my balance sheet, which looks like substantial loanable funds, and I'd love to loan those funds out.
Thank you very much, gentlemen, and I yield back, Mr. Chairman.
Thank you. I have just a couple quick final questions. Mr. Daly, you stated that, quote, some small curtailment of available credit over the long term is favorably outweighed by the certainty that sensible requirements to mitigate risk will stabilize credit markets over the long term and lessen the likelihood of another financial collapse. What data can you point to show that the current regulations are merely sensible and not burdensome, and that they'll prevent another financial crisis?
I'm not going to point to that. I don't have data that would make a prediction like that. And I must be clear that the provisions related to reserving in Dodd-Frank are very complex. And I believe that there is a legitimate debate about whether they need to be uniformly applied, or is there some way that they can be, that different institutions with different circumstances should have different applicability of those reserving requirements. But the underlying idea of there being those reserving requirements in place and being applied throughout lending institutions is important to the long-term stability of credit. And that's what I'm trying to express here, that having some base requirement there. I do think there's a legitimate debate about how exactly to apply those provisions of the law, but that there be provisions like that is important to the long-term stability of credit.
Your members are small business owners. Did they support the repeal of the 1099 aspect of Obamacare?
Yes.
Overwhelmingly.
Well, there was one sense of hesitation. It was the pay for. The original proposals to pay for the repeal of the 1099 provision undermined aspects of the ACA, of the Affordable Care Act, which they supported passage.
In describing your membership briefly, this is a real short answer. These small business owners, do they feel overregulated and overtaxed?
to the degree I've had conversations with them about these things, they don't say they're overregulated and they're overtaxed. They're much more concerned about what happens to the money that they pay. Where is it invested? They're much more concerned about what impact the general quality of life in their community has on them than anything else. And
you and I need to take a day. We'll go randomly find 100 small business owners around the country. We'll ask them that question. Thank you. One final question for the three bankers. In essence, you are all small businessmen. Correct. What, to your estimation, and be brief, is, as small businessmen, your greatest fear right now for the small business community?
My greatest fear is where does this regulation stop? Every time we have to comply with a new regulation, we are just having to spend that much more time on the regulation and that much less time supporting small business people. We completely understand their need for capital. We completely understand our role in that. We are in business to make loans. We're in business to support our communities. There doesn't need to be a regulation to tell us how to support our communities, because if we don't do that, our communities won't do business with us. So it's not complicated in a community bank. We just need to find a way to be able to get out from under the burden of oppressive regulation.
Mr. Sekula.
Well, the concern definitely is about the overreaching, the regulation. Right now we're talking about investing and taking care of our members, their needs right now. That's all that they can think of right now. So some of them are not investing in growing their business or seeking loans because of the fear and the uncertainty. But when they come to us, we want to make sure that they feel comfortable that we're going to be there to take care of their needs, whatever it may be. When we have our regulators, whether it be the National Credit Union Association or through the SBA, hindering and preventing us from getting in that way, especially for a well-positioned financial institution to be able to take care of them, what kind of message does that send? And that's my biggest fear, is that we think that we've done everything right to take care of our business, the way we operate and our members, and now I'm being possibly restricted from being able to get them access. That concerns me, because we think we're doing everything right, but now I'm being told you need to be careful.
Mr. Boyle, your greatest concern for the small business community?
I've been a banker for 34 years, and I started off as a regulator and moved into the banking environment. And in those 34 years, I could not recall a regulation being retracted. Every time they put in a new layer of regulation on us, it costs us money. This new regulation for Dodd-Frank, as I mentioned earlier, could cost us as much as an extra $150,000 a year. The debit change effect last week, where we lost on that, man, those are $200,000 a year there. That's $300,000 in profits I don't know how I'm going to make up. And if I had those dollars as capital, I could make as much as $30 million in new loans. So the leveraging aspect worries me. The overregulation is only going to hamper my ability to become more profitable.
Thank you. I'm done. Mr. Schrader, any follow-up? Great. Thanks. Now that the questions are complete, I'd like to again thank our witnesses for being here today to discuss this important issue for small business. We know that small businesses will lead any economic recovery and jobs recovery. So today was a step in the right direction towards focusing our efforts on determining the law and resulting regulatory impact on small business. As we move forward with the implementation of this law, I'd like to encourage the participants here today to keep us informed about the issues discussed. It's important that we know the exact impact of policies for those who are working every day to grow businesses and create jobs. With that, I ask unanimous consent that members have 5 days, legislative days, to submit statements and supporting materials for the record. Without objection, so ordered. The hearing is now adjourned. Thank you.